Okay, let's dive into this. Picture your classic Hollywood trading floor scene, right? Dozens of flashing monitors, charts just exploding and crashing in literal fractions of a second, and this absolute suffocating tension in the air. It really feels like surviving in that environment requires just this insane, boundless energy, raw aggression, and the ability to make like 100 decisions a minute. But today, we're going to challenge that exact stereotype. We're breaking down the fundamental mechanics of market survival based on our source materials. And what we'll find out is what actually drives successful investing. Is it constant, frantic hustle, or is it cold, detached calculation?
So this brings us to the core intellectual dilemma of today's explainer. What is genuinely more important for protecting and growing capital? Is it the domain of business logic, that relentless energy, constant initiative, and hair-trigger reactions to every single price tick? Or is the real key to success structural logic? We're talking total self-control, deep immersion into the math, and strict, rigid algorithms. Well, let's look at the facts impartially, with no biases, and figure out exactly which type of thinking actually rules the market in the long run.
Entry points, stop losses, take profits, rapid portfolio diversification, instant rebalancing, constantly calculating the expectancy of your strategy in real time. All of this just screams efficiency, right? It screams fast, measurable results. Looking at this frantic, adrenaline-fueled pace, you kind of have to wonder, isn't this just pure extroverted business logic in action? Isn't this exact nonstop drive what makes millions on Wall Street? No. Just stop for a second. Take a breath. All that hustle, all that sky-high adrenaline, it's literally just a superficial illusion. The source data we're analyzing today makes it absolutely clear that the essence of profitable trading is something completely different. We've just shattered that cinematic illusion of the frantic trader, and now we're going for a deep dive into reality.
Section 1. The illusion of speed in trading.
Now, what's really interesting here is how the source perfectly describes business logic in the context of modern markets. This extroverted function is incredibly initiative-driven. It's packed with energy. People with this mindset, they think dynamically, literally on the fly while they're working. And hey, that works brilliantly for simple, fast-paced systems where you need quick tactical flexibility. But the catch? Modern finance is this massively complex global system full of hidden variables. Business logic just doesn't build complex branching plans beforehand. It solves immediate tactical problems on the fly, jumping from one asset to another. But it fundamentally lacks the deep immersion and strategic foresight needed for actual capital survival.
Section 2. Business versus structural logic.
The contrast here is super stark. On one side, we have the ultimate representative of business logic, the fast, restless tactician who adapts to situations in the moment. On the flip side, we have the structural logic type. According to the materials, structural logic is the true language of accounting, of complex statistics, and rigorous risk management systems. It's about absolute self-control. So while the first type is rushing around, burning massive amounts of energy trying to adapt to every new candle on the chart, the second type is building their system slowly but flawlessly. It really highlights that the fundamental difference between business and structural logic is the ability to think decades ahead, rather than just 5 minutes.
There's this common myth that the structural thinker only invents the mathematical model and then leaves the actual execution, the button pushing, to the energetic business thinker. But the source emphasizes that this is completely wrong. The structural approach demands serious time. We're talking hours for meticulous data analysis, weeks to build an absolutely bulletproof algorithm, and most importantly, years of methodical execution. It's structural logic that has the endurance to follow a routine day after day without ever trying to outsmart the system on the fly. But what happens when this perfectly calculated plan crashes into the chaotic, unpredictable reality of the market?
Section 3. FUD, FOMO, and iron endurance.
So the crucial point is how these different mindsets react under extreme emotional pressure. Think about FUD, fear, uncertainty, and doubt, when markets are crashing and everyone is panic selling at a massive loss. Or FOMO, the fear of missing out, when an asset is skyrocketing, hitting all-time highs, and the euphoric crowd is buying at the absolute peak. Energetic business logic, which loves making quick decisions in the moment, often breaks under this pressure, caving to the impulses of the crowd. But structural logic, it stays ice cold and calculated. It just treats all that panic and euphoria as pure mathematical noise. A genuinely successful investor doesn't make decisions based on the madness of crowds. Structural logic, as the author points out, is quite literally the ability to maintain absolute composure when the rest of the world is losing its mind. It's profound self-control taken to the absolute maximum. No spontaneous moves, no improvising just for the thrill of it. Just rigid, methodical adherence to the strategy that was laid out long before the market storm even hit. That is the iron endurance required to keep your accounts from going straight to zero. Section 4. The anatomy of capital survival. Let's move along and see exactly how this algorithmic survival process builds step by step. Step 1. Develop your strategy in a calm environment, well in advance, totally free from the stress of open positions. Step 2. Methodically endure the inevitable drawdowns. When your portfolio is bleeding red and the news is screaming about the end of the world, you don't panic, you just wait, because your math already accounted for this. And step 3, which is definitely the hardest, never realize your losses during moments of maximum market pressure. This takes truly colossal endurance. You literally have to shut off your emotions, ignore that inner voice begging you to salvage whatever cash is left, and become a flawless, impartial executor of your own algorithm.
And historical data brilliantly backs this up, looking at both traditional stock markets and highly volatile crypto exchanges. The survival of your capital doesn't actually depend on your organizational skills or having lightning-fast reaction times. Those factors have a surprisingly low impact. What really matters, the true foundation of long-term profit, is a systemic approach. A complex, calculated system will beat frantic speed and intuitive guesswork every single time.
Section 5. Trader or platform organizer. To sum up the core thesis of the material, trading isn't a contest of energy. It's a test of endurance. It's a battle of mental discipline. Structural logic creates the exact traits you desperately need for the marathon of investing. Immense patience, total immunity to panic, and the ability to deeply immerse yourself in the statistics while completely ignoring all the daily noise and short-term volatility. It's not the fastest who survive, it's the most disciplined.
Which leaves us with a final, pretty provocative question posed directly by the author. If you recognized yourself in the description of the business logic type, if you're quick, full of initiative, hate monotonous routines, and love solving problems on the fly, well, maybe you shouldn't be trading at all. Maybe your actual superpower is organizing those structural thinkers, managing a team, or building the ultimate trading platform for them. It's definitely something to think about. Consider how your own natural mechanics fit into the broader financial ecosystem. Play the game where your logic actually gives you the edge. Thanks for joining us for this explainer, and we'll see you next time.